Billions vanished overnight, quicker than screens. This tech initial public offering frenzy reshaped investment for 2 decades. Over 150 new tech companies went public in a single year, many reaching market caps 500 times their actual earnings. Investors poured in collective hundreds of billions of dollars, betting on unproven potential, ignoring financial metrics. One .com startup for online pet supplies hit a $700 million valuation with under $2 million in annual revenue and 0 profit history. Another internet search engine, before market dominance, secured $900 million in funding based on projected user growth of 10 million new accounts monthly, a target never met. Venture capitalists saw returns exceeding 1,000% on early investments, fueling a speculative bubble. Retail investors joined in droves, with over 25 million individual trading accounts opened during the peak year, seeking guaranteed wealth. Average initial share price pop on day one was an astounding 120% for tech IPOs. Many firms were built on elaborate plans and relentless buzzwords, like disruptive innovation, paradigm shift, synergistic ecosystems. They burned cash at over $20 million monthly without clear paths to profitability. Analysts cited price-to-sales ratios over 200 compared to a healthy 2 or 3. Unique domain names registered surged from 8 million to nearly 100 million in 3 years. Employee stock options made thousands of paper millionaires. Then the brutal market correction began. Over 3 years, nearly 2/3 of these public tech companies saw stock prices plummet by 80% or more. About 1,500 firms faced bankruptcy or were acquired for pennies. Investor confidence evaporated, leading to losses estimated in trillions of dollars. Unemployment in tech surged from under 2% to over 8%, affecting hundreds of thousands of workers. Average time for a tech startup to reach profitability post-IPO increased from an optimistic 2 years to more realistic 7 years post-bubble. This era proved pure hype cannot sustain companies without real earnings and robust business models. It taught future entrepreneurs and investors a harsh lesson about perceived value versus inherent worth, costing fortunes. The aftermath permanently altered regulatory oversight due diligence. Hundreds of millions of shares became worthless shares. A broadband provider that achieved a $20 billion valuation collapsed, leaving 20,000 employees jobless, its technology obsolete, showcasing how market sentiment drives everything until economic realities brutally kick in. This forged a new cautious approach for market entries. Trillions vanished like mist. The tech initial public offering bubble burst with a resounding crash, shocking global financial markets. The euphoria of easy money quickly evaporated, revealing hollow valuations built on speculation and empty promises. Initial public offering day one pops often exceeded 120%, showcasing investor madness. Hundreds of companies once lauded as future titans saw their market caps plummet by over 90% within weeks. An e-commerce platform peaked at $5 billion valuation, then traded at less than $1. One pet supplies firm reached $700 million valuation, under $2 million revenue. Average stock price drop for hundreds of public tech firms was a staggering 85%. Many businesses funded by hundreds of billions never achieved profitability, burning over $20 million monthly. Thousands of paper millionaires from employee stock options watched wealth disappear, many facing bankruptcy. Over 1,500 tech firms went bust, or were acquired for pennies, ending reckless investment. Tech unemployment skyrocketed from sub 2% to 8.5%, affecting hundreds of thousands of workers. Investors learned perceived value without inherent worth is unsustainable. Analysts championing high flyers scrambled to explain why price-to-sales ratios over 200 were flawed. The dot-com boom-bust reshaped venture capital funding, scrutinizing business models and paths to profitability. Retail investors pouring life savings into growth stocks faced crippling losses totaling trillions of dollars. Average time for tech startup profitability post-initial public offering stretched from 2 years to 7 years, reflecting market maturity. This period shifted towards rigorous due diligence and tangible earnings, rejecting buzzwords like synergistic ecosystems and disruptive innovation. Regulators examined market practices more closely to prevent another speculative bubble. Market entry transformed from sprint to marathon, requiring solid foundations. Hundreds of millions of shares became worthless, reminding all that hype cannot substitute robust economic fundamentals. A broadband provider with $20 billion valuation collapsed, leaving 20,000 employees jobless, its technology obsolete. A stark reminder until economic realities assert dominance. The cautious approach became the new standard for future public offerings, ensuring realistic valuations and sustainable growth models. Companies with zero revenue soared to billion-dollar valuations. The tech initial public offering frenzy of the late 1990s ignited a gold rush like no other. Everyone wanted a piece of the internet pie. From 1995 to 2000, hundreds of companies rushed to market with little more than a catchy domain name and a business plan scrawled on a napkin. Initial public offering day one pops of 150% were not uncommon, some stocks even climbing 500% in a single day of trading. This rapid ascent created an illusion of effortless wealth, drawing millions of new retail investors into the stock market. These were not seasoned traders, but everyday people pouring their life savings into the latest dot-com darling. Many believed traditional valuation metrics were obsolete, superseded by new age concepts like unique visitors and page views. Analysts eagerly championed these high flyers, ignoring fundamental profitability. They often presented price-to-sales ratios exceeding 100 or even 200, as justified by future growth potential. Venture capital firms pumped billions into startups, accelerating their journey to public markets, creating immense pressure for early exits. Companies sometimes less than 2 years old, with minimal revenue, perhaps under $5 million or even no earnings whatsoever, found themselves valued at hundreds of millions or even billions of dollars. One online pet supplies company, despite minimal sales, went public with a $900 million valuation, an astounding figure. The total market capitalization of tech stocks exploded by several trillion dollars over this 5-year period, with the NASDAQ index itself surging by 500%. This period saw the creation of tens of thousands of paper millionaires, employees and early investors watching their net worths skyrocket on paper. The media fueled this euphoria with constant stories of instant millionaires and innovative new internet companies promising to revolutionize every industry. Billions were spent on lavish marketing campaigns, even by companies bleeding cash at an alarming rate, just to gain brand recognition. Commercial real estate in tech hubs like Silicon Valley and Seattle saw rents increase by 300% annually as startups clamored for space. Investment banks eagerly underwrote these offerings, collecting massive fees from the often unprofitable companies. Everyone involved, from the company founders to the last retail investor, felt invincible, believing the internet economy was immune to traditional economic cycles. The average annual stock appreciation for dot-coms during this peak period was an astonishing 300%, a rate unsustainable by any measure. This rampant speculation built enormous castles in the air based on future dreams, not present realities. It was a time when buzzwords like synergistic ecosystems and disruptive innovation could command a higher premium than actual earnings. The greater fool theory was in full effect, where investors bought simply because they believed someone else would pay an even higher price tomorrow. This collective delusion set the stage for an inevitable and brutal awakening. The total number of initial public offerings surpassed 1,500. This 4-year window, over $50 billion was raised in one record-breaking year alone. Thousands of new businesses were born on the promise of the internet economy, attracting hundreds of billions in total investment capital. The sheer volume and speed of wealth creation during this time was unprecedented and intoxicating.